Alright, so I just wanted to review with you real quick about the situation we're in and the ultimate effect of all the money we've printed and how that affects your existing position. So they're not talking about a lot of this about the media. They're not going to start talking about it, like just like they didn't talk about it before 2008. They did not warn people. It's not, they don't really want people to get out. They want their customers to get out, which is ultimately corporations. So a lot of company stocks, a lot of company insiders are selling their own stock because they think it's overvalued. So, like for example, at GoDaddy, several $100,000 in stocks, the top executive, they all cash it out because they know what's coming. And you just got to be aware of it. And even in traditional safe havens, are just not safe. So even cash in 2008, you guys were cool, or you would have been more protected. But in this situation, ultimately, when hyperinflation picks up, that cash is going to be worthless. But the other danger is, and I sent you the article earlier, which is even FDIC insurance only has a 4% coverage, and they have to bail out the banks first, which is several quadrillion dollars, like over $100 trillion first, before they start paying out FDIC or bailing out banks. So even that, traditionally they want to say it's safe, but it's not safe. That is still a dangerous investment to be in, even in cash in a bank account. So far beyond what a lot of people will say, but when you look at the history of things, it is very obvious that one, they're going to use that cash as their own reserve to bail out their own bank. It's called a bail-in. You already see it in Greece. It's already legal. And it can tie you up for a long time and be a very risky position. So this traditional safe havens, not good. So let's explore where we're at. So we could be around this hump right here or right here. Different investment advisors are telling me different things, and again, nobody's going to be completely accurate on this. This is the Weimar Germany inflation in the early 1920s, but it always follows the same curve. Again, they're going to be much more detailed in the video I sent you earlier as far as the history of this goes. But let's look at how this is the general pattern of hyperinflation, and let's talk about your position and where you're at. So let's consider like $100,000, for example. Okay, so you're sitting in $100,000 cash. That's not bad in this type of economy. I mean, if it's not tied up in a mortgage, if it's not tied up in the stock market, then that's a better position. So say we're around this hump right here, and so a lot of people are saying the stock market's peaked. Again, it may surge up even a little bit more, but it is pretty flatlined. If you look at the current Dow index, and so if it's at the peak, that's fine. What you could see is 2 or 3 years before you fully hit the bottom of a crash, of a correction, as they say, right? So yeah, there's going to be a big crash, a big correction. You'll see the full reasoning in the videos I sent earlier. It is way overvalued, and the market will correct itself, and it's gonna come way down. So sitting in cash, not bad. You still have year-over-year inflation, but once those prices drop, at that point, you can buy a business for pennies on the dollar. So you can get a $1 million property for $600,000 or $500,000. or any scale beyond that. So you'll see a 30% to 40 to 50% correction. So whether that's another investment property or whether that is your home, 2 to 3 years is when you're looking at ultimately looking to pick that up at the lowest price. So even that, though, you want to be able to be sustainable. So it's another motel, another an apartment complex, so that's great for revenue generation, or like an agricultural land farm house situation where you can have well water, where you can have solar panels. Because when this hyperinflation hits, traditional sources of electricity, of food, etc., price is going to go way up. And again, you maybe have a year before you see the hyperinflation, but ultimately you get the dip in prices and a slight deflation for about a year, could be much less. So 6 months to a year, you have a good window to buy a property. You have a good way to prepare yourself for hyperinflation, which is going to happen. I mean, with the dollars that we have circulating around the world, once we're no longer, it's not good for anything. They're going to look to buy. All that money is going to be rushing into the economy. They're going to start raising the price of goods because, again, you have all this demands out there, but that money is going to be worth less and less. So once the panic hits in, it shoots up within 2 or 3 months. Okay, so now the way I would position it is the recommended of almost any stock advisor is going to say, hey, move 10% into gold and silver, 10% into hard metals. All that does is keep you level financially. So it doesn't move you forward, doesn't move you backward. Because they say 10% because metals during hyperinflation inflate 10 times. So if the value of your money goes down by 10 times and your metals go up by 10 times, you're break even. And that's what that position is, that strategy is designed to do. So 10% of money into silver and gold, you're staying even keel. Now, if you want to be a more savvy player, again, if you're convinced this is going to happen, and we're absolutely on track to do that within months. So within like 6 months, you'll see things start to deflate. While asset bubbles start to crash, gold and silver starting to go up. So you're already they're already up for the year. So they're already good, but they're gonna grow pretty significantly. So you want to position yourself in. Now, what I would do in order to end up ahead of it, cash is okay. I would move at least 30 to 40%, even up to 70% into silver and gold, just because it's a really low risk thing to do, considering it's easy to get out of and considering the potential upside. So now when you're talking 40 to 60%, you're talking about 10 times that. So ultimately, once that gold price goes up, which is right here, you could still be buying assets even though prices are escalating. People are going to still be desperate. They're going to look to offload their properties in order to get basic supplies, etc. So there's stories of this era where people buy motels for, the equivalent of $1,000 gold coin. They buy entire hotels. So, understand that, there are ways to pick up properties that are completely recession resistant, but 30 to 40% puts you in a position to operate and not only multiply your kind of wealth several times over. So this is that is the thinking between, like, the safe move is 10%, the power move is between 30 to 70%. So this is what my investment advisors are telling me. I mean, those are all my customers. I talk to them all day long. So let's look at something else here. So this is the price of gold over the last, this is 20 years. So it's remained fairly stable. And then you saw the 2008 bubble. So this is when the stock market collapsed, and you saw slight deflation. So ideally, this is the time to buy during the deflation, or if you see this coming, which is we're about here. So the price of gold is reflective of the strength of a currency, really. So the higher gold is in your currency, the weaker your currency is. And this is what you have to understand. So this is the higher this is, the worse we are off as an economy, but obviously the better you off as a investor, right? So you can buy here, and this is after the deflation of the crash. So this is 2008. You have a deflation. You can buy here. This is risky. You actually want to buy before it. We are before the crash right here. And again, I know this moves up, so it doesn't look like a crash, but this is the 2008 crash. So economy does bad, gold does good. And so you'll see it went from 600 to 900, so 30% jump in a crash. Now, again, a lot of people are saying that 2008 was nothing, and it really is nothing. We didn't correct this crisis. We really didn't go into a recession. We printed our way out of it, and so we never felt the effect. So it's like an addict going through withdrawal and using other drugs to get through that withdrawal. We never really felt that correction. So despite this move upwards, and this is actually a sign of the U.S. economy doing bad. You see gold price double, right? Double here, which means the U.S. economy is that much weaker. But again, we're not going to see it go back down to here. We are inching upwards, so you'll see in the last couple years it's remained fairly stable. And this, by any estimate, this is going to go way up. So that's the warning, that's the sign. But 2012, during this period, I mean, it would have doubled, but you see it's remaining fairly stable at about 1,200, and yeah, it could drop down to $1,000. But again, buying at the deflation dip after the crash, that is a risky bet. So generally you want to buy around here and sell once it peaks, which is 2 to 3 years, right? So that is one thing to think about. Again, it is a very good strategy in this situation, but it's very, very risky. So right now the stock market environment, very, very risky, and that's how you position out of it. This is how you get ahead of it. So yeah, I just stay informed about things, stay aware of things. That money history of money series, very, very good about explaining the dynamics here. Just give you an overview of what my investment advisors are telling me. So let me know if you have any questions or issues here. I've done a lot of this right now already, so I've already moved a lot of my assets into this. All right, well, take care, and let me know if you need anything. Bye-bye.